Hey guys, this video will introduce you to some of the candlestick chart basics. We use charts a lot in trading and they're great because they give us a visual image of all the numbers we are keeping track of. And there's different kinds of charts, but the most popular is the candlestick chart. So for the purpose of my lesson, I'm going to use the candlestick chart because I use them myself in my own charting. Now first of all, the best resource for free charts for those of you that don't yet have a trading platform is this website called Stockcharts.com. It's completely free and you just type in the ticker symbol that you want to look at and it'll bring up a chart. And there's also some other useful material on there. First of all though, here's what a candlestick chart looks like, a simple view. This is an example of Starbucks candlestick chart, and there's a couple different things going on here. First of all, the symbol, we know it's Starbucks because if we look up at the top, we see Starbucks Corporation listed there. The symbol is SBUX. And we know that this chart is showing a daily time frame, meaning that every single one of these candles that you see represents 1 day's worth of trading. The y-axis represents the price and the x-axis represents the time. You can see the dates listed on the x-axis. Also, we have the opening of the day, the high of the day, the low of the day, and the volume, as well as the percentage change and the last quote listed at the top of the chart. As far as changing any attributes, you can do that in the bottom left area here, which is circled. You can change the time period, you can change how many months it's showing, you can change the type of chart you're looking at. Again, we're going over candlesticks, but there are others you could look at and other various things you could do with that. Now, as for the chart itself, you will notice that each day is represented by figures which again are called candlesticks because of the way they resemble candles. We'll look at an image here that makes it look a little bit more clear, sorry. So now you can see it looks like a candle because if you imagine a candle, you've got a wick and you've got a body of a candle. So this is where they get their name from. Now how do you interpret this? Well, on a green day, the bottom of the candle down here is where the stock price opened. And then the top is where the price closed. And then these wicks here, as they're referred to, represents the total daily range on the day. So you might have a stock open at $5, trade down to $4.50, close at $5.50, but it went as high as $5.75. Because it went as high as $5.75 and as low as $5.50, you have wicks down there. But since it opened at 5 and closed at $5.50, the body of the candle only makes up the open to closing range. And again, on a green day, the bottom represents the open and the top represents the close. Now for a red day, we just flip everything completely backwards. The top represents the open, so you might have opened at 5, and the bottom of the body represents the close, so let's say you closed at $4.75, and the wicks represent the total daily range from the high and the low. So maybe the high was $5.25 and the low was $4.50. Just because you traded down to $4.50 but you didn't close down there, you closed at $4.75, you're going to have this little wick. And because you traded up to $5.25 but you opened at 5, you'll have this wick up here. The body always makes up the open to the closing range. And on a day where prices are moving higher, the body will be a green candle, or on days when prices are moving lower, the body will be a red candle. One note, if you're using Stockcharts.com for this, it shows green days as white body candles. Don't ask me why, that's just the way they do it. But most platforms are defaulted to show green and red for up or down. Now you might have noticed on our Starbucks chart we've got a couple black colored candles like this and this and this. What do those black colors mean? So on a black candle day, it means that while the stock closed positive on the day, the price finished below its opening price. So, for example, we might have opened at 50 cents, sorry, $5.50 from a previous day's close of $5, but closed at $5.25. So, and then the high and the low is just the same thing as it is. So while we actually were up on the day compared to the previous day, we closed beneath the opening price. So to read an example, say on Tuesday ABC closes at 45. On Wednesday ABC opens at 46 but closes at 45.25. Now compared to Tuesday, ABC was up 25 cents on the day, but compared to where it opened, it was actually down 75 cents. And again, anytime this happens, it will show up in a black candle or whatever default color your platform is using. Now the opposite of a black candle is a negative day where the price closes above the opening price. Sometimes the candle looks like this. It'll look like a hollow candle in some instances. So for example, Tuesday ABC closes at 45. On Wednesday, ABC opens at 44 but closes at 44.75. So while ABC was down 25 cents on the day compared to Tuesday, it was actually up 75 cents compared to where it opened. Why are black candles and hollow candles so important? Well, you could have a stock that was up on the day, but if it's significantly below the opening price, then that could still signal sellers were in control. So if we go back to this black candle, say you open up here at, 45 bucks and the previous day's close was 40, so you're up 5 points at the open. Well, what if the stock closes at 41 down here? You're going to get a black candle and now you're only up 1 point, and you actually dropped 4 points on the day between this body. So that changes our psychological interpretation. At least it changes my psychological interpretation, because now you say, all right, well, what was a great day actually felt more like a selling day. It's like when a team is blowing a team out by 40 points after the second quarter, but then they only win the game by 5 points. They still won, but you maybe don't feel as good about that victory as you did when you were blowing the other team out. And it's the opposite psychological thinking on the hollow candles, where the stock might be down 5 points at the open, which looks awful, but by the close it's only down 1 point. Yes, it was still down a point on the day, but being down 1 is a lot more positive than having been down 5. So black candles and hollow candles are important to keep track of and pay attention to when you notice them. Now I just want to look at a few charts to reinforce the terminology here and what we've seen. We're looking at a chart of Starbucks right now, a current chart, and you can see that Starbucks has today a down candle, but we do have a couple hollow candles that have shown up from time to time. You've got a couple black candles here, a couple wide body white candles. And now when I say wide body, that's referring to the open to the close range. So like today is a skinny body because the current price is very close to where it opened. Sometimes you might hear people refer to these types of candles as dojis. For trading purposes, day trading purposes, wide body candles are better than skinny body candles in my opinion. Here's a chart of NVIDIA. Not a lot of hollow candles or black candles on NVIDIA. A lot of wide body upside candles recently. JP Morgan, handful of black candles, and a lot of gaps on the chart too, which is a term that we'll learn about in a different video. And Pepsi with a good indication of that hollow candle yesterday, where yeah, it's down on the day, but you know, stock stayed up near its recent high, and now today a nice wide body breakout to a new 3-month high in the stock. Good example of where those hollow candles can sometimes actually signal strength as opposed to weakness. And lastly, we've got Shutterfly. Not many hollows or black candles on Shutterfly. So if you're using Stockcharts.com, anytime you see a white candle, it means the price was up. Red candle, price was down. And we've already gone over black candles and hollow candles. So with that understood, the main concept to grasp from these charts and how they can help us is that they identify reference points for us. And the 3 important reference points that they identify is the opening price, the closing price, and the high and the low. What is the day's range? Everything we do in charting is based off of these prices. They will help us identify volatility. In addition, they will also help us identify which way a stock is going. And the 2 buzzwords you hear most are bullish or bearish. Bullish is when a stock is going higher. So if the stock was 10 at the beginning of the week and is 11 at the end of the week, it is said to have made a bullish move. Bearish is when a stock is going lower. If it was 10 at the beginning of the week and is now 9 at the end of the week, it's said to have made a bearish move. Now, less heard but equally important is the term neutral. Neutral is when a stock is unchanged, meaning it was 10 at the beginning of the week and now it's 10 at the end of the week. That means it was neutral. Nobody was really in charge. Based on these buzzwords, we can start to identify who is in control of a stock. So when a stock is bullish, the bulls are in control and it's going higher. When it's bearish, the bears are in control and it's going lower. When it's neither bullish or bearish, it's neutral and no one has a clear advantage. Now, I've got a number of different ways that we can identify bullish versus bearish versus neutral, and this is just a handful of examples. There's all types of ways, really. But if a stock closes at its high for the day with a wide body candle higher, then you might say it's in a bullish, or it had a bullish day. If we look at this example again of Shutterfly, you see here this candle here, great example of a very bullish day where you very wide body close at the high of the day and it then continued higher in the following week. It doesn't always work like that, but just an example of what I'm talking about. Now, a stock that closes at its low of the day with a wide body candle is said to be in a bearish trend, potentially. Now, recently the market's been going up a ton, so we don't have a lot of great bearish examples to point to, but if we look back on Pepsi, we can see some from early May where the stock had a big wide body drop to the downside and then another one, and both of those, did continue lower over the next week. So that would identify or help to identify a bearish advantage when you get one of those wide body negative closes. Now, a stock that closes between its high and low, skinny body with wide wicks per se, that looks like a neutral candle. And we're getting one of those candles today on Starbucks, really, where you've got a decent range, but it looks like it's going to close kind of right in between. So this kind of looks like neutral price action to me on Starbucks based on that candle. Now, other examples would be when a stock closes above its opening price and above its previous day's close. That would be a bullish sign. or a stock that closes below its opening price and below its previous day's close. That's a bearish sign. You say, well, doesn't a stock always close above its opening price and above its previous day's close? No, not always. For example, on Pepsi recently, we had the stock put in a black candle where it closes above its previous day's close, but it closed below its opening price. And it didn't move right away. It took about a day and a half before the move higher actually started. You might have a stock closing above its opening price, but below its previous day's close. That's where you get one of those hollow red candles. That could be neutral. A stock that closes below its opening price but above its previous day's close, that would be a black candle like I just showed you, that could be a neutral sign as well. Now when a stock closes above its previous day's high, that's bullish. A stock that closes below its previous day's low, that's bearish. So again, just to reinforce some things using Pepsi, great example on Pepsi of a move that started about 3 weeks ago with this candle right here, where you close above the previous day's high. And then the next candle closes well above the previous day's high. And you just never really looked back since about 3 weeks ago. Pepsi's just been on a really nice run. You look at JP Morgan. When did JP Morgan bottom out? Well, it was this sequence here when the stock was able to close above its previous day's high, and since then the stock's been on a run. So you want to watch for when stocks close above or below their previous day's high or previous day's low. And if the stock's closing in between the previous day's high or the previous day's low, meaning it stays in between the previous day's range, that would be a sign of neutral price action. And again, if we look at Starbucks, Starbucks looks to be on track to register one of those closes where it's not going to be below yesterday's low and it's not going to be above yesterday's high either. Now we could go on and on with more examples of ways we interpret candles, but ultimately the most important thing is to identify an advantage. Bullish, bearish, or neutral. Who has the advantage? That's the question I want to be able to answer. That's what I'm always thinking about when I'm looking at different stocks. You need to understand too that advantages are all relative to time periods. A stock could look bearish in the short term, but bullish in the long term, depending on if you're looking at a 1 week or 2 week chart versus a 6 month or 12-month chart. You might see conflicting signals. It's the idea of advantage that determines which way I bet on a stock going. If I see a bullish advantage, then I want to bet on prices going higher. A bearish advantage, I want to bet on prices going lower. And if I don't see any advantage, meaning it's neutral, then I don't want to make much of a bet one way or the other. Now, as mentioned above, advantages can vary depending on time frame. So to help you, here's the way I look at it. In the very short term, the day-to-day, the most important reference points to me are as follows. The previous day's high, the previous day's low, and the previous day's close. In the intermediate term, week to week, the most important reference points are the previous week's high, the previous week's low, and the previous week's close. And again, if you're using Stockcharts.com, you can adjust the period setting or change the time frame by adjusting the period setting, which shows up right here in the lower left-hand corner underneath the stock chart. Now, another component of charting is volume. Volume represents the amount of shares a certain stock is trading. Now, charts are nice because they help us visualize that volume, and we can see if some stocks have sporadic volume patterns or are they consistent. So, like if we look at Starbucks, here's the volume down here, and it is pretty consistent. You know, generally about 10 million shares per day, somewhere around there. However, a stock like Shutterfly has much more sporadic volume and much lower volume. Notice that Shutterfly only trades about 200,000 shares a day or so, and sometimes you get these bigger volume spikes, and then sometimes you get incredibly low volume. So Shutterfly, more sporadic. Now, volume is important because one stock might move on volume differently than another stock moves on volume. Said another way, a stock like Shutterfly doesn't need nearly as much volume to make the move that a stock like Starbucks does. So if we look at Shutterfly, for example, you can see we've gone from $44.50 up to $50, a 10% plus move over the last couple of weeks, and our volume really hasn't been much greater than 200,000 shares per day, if that. Whereas we look at Starbucks, and we've gone from $53.50 up to $57.50, not quite 10%, but look at our volume. Our volume's been, 10 million shares a day. So the bottom line is Starbucks needs much greater volume to move than Shutterfly does. And the way we might apply that to our trading is if we're watching a stock like Shutterfly and we see high volume right at the open, we might be able to anticipate that it's going to be a very volatile day in the stock. Or with Starbucks, if we see low volume at the open and we know that it needs high volume to be able to move because it's already a high volume trading stock, then we could possibly anticipate that Starbucks isn't going to make a good move today and we should probably just leave it alone. So volume is important, and again, in future lessons I'll get into more advanced concepts to understand. So hope you enjoyed this. In my next lesson coming up, I'll highlight another important component that I mentioned on candlestick charts, and that is gaps. So please email me, Kevin@Watchhimtrade.com, if you have any questions or comments. Thanks.